Hi guys. Today we will analyze Truist Financial Corporation stock, and calculate its intrinsic value using two different valuation models. Enjoy! Hit the like button and subscribe to my channel if you want to see more videos like this. Technical analysis. The stock's overall performance in the market is below average. Also, recent evolutions are not positive. The short-term trend is negative. The long-term trend is still neutral, but it can change at any moment. Strong support levels are around $52 and $50. Next strong support levels are around $46 and $40. Strong resistance levels are around $56.50 and $60.50. Next strong resistance level is around $65. In the last month the stock has been trading between $51.70 and $61 range. It is currently trading near the lows of this range. The stock has an average volume of 6.9 million. This is a good sign, as it is always nice to have a liquid stock. The stock has been in a downward trend since January 2022. Be careful. Intrinsic value. Buy low, sell high. We have heard it many times before. But how to know when it's low, and when it's high? The intrinsic value of a stock is its true value. It refers to what a stock is actually worth, even if some investors think it's worth a lot more than that amount. Intrinsic value is important, because it can help investors understand whether the cost of a stock is undervalued, or overvalued compared to the market value of the stock. Valuing financial institutions. Understanding why financial institutions are different from traditional real sector companies is key. Banks function differently than traditional cash flow-driven companies. Traditional companies create products to make money. The products of banks are money. Banks are highly levered and they do not reinvest debt in the business and instead use it to create more money. They make money via interest. So, they view debt and interest differently. That's why our favorite discounted cash flow valuation method doesn't work for banks and insurance companies. Intrinsic values calculations. Let's calculate the stock's intrinsic value. For more accurate results, we will use two different valuation models to calculate the intrinsic value of the stock. The excess return model. This approach is used for financial institutions where free cash flow is difficult to estimate. Then, we will use valuation based on earnings per share, EPS, 5-year average P/E ratio and expected growth rate. First model. Excess return model valuation. This spreadsheet contains some financial data that we will use for the stock valuation. In this valuation I will use margin of safety. 30%. Once we actually figure out what we think this stock is worth, we are only going to buy the stock if it gets 30% of what we think it's worth. It gives us a big margin of safety if our predictions are wrong. In other words, when something is worth $1, I want to pay only 70 cents for it. I want to be conservative with financial institutions. So, my margin of safety is 30%. According to our formula, the fair value of the stock is $81.67. When we apply the margin of safety to that value, the fair value of the stock would be $57.17. That's the price that I may want to pay for this stock. Second model. Valuation based on earnings per share. This spreadsheet contains another financial data that we will use for the stock valuation. The current earning per share price for Truist is 4.47. Minimum rate of return. I will use 10%. Because when we invest in individual companies, we are looking for a higher return than the S&P 500. For Truist, analysts forecast growth rate around 5% per year in next 5 years, and future P/E around 11. I will use 3 different scenarios for Truist Company: bad, average, and good. First scenario. Truist will have bad performance in next 5 years, and we will use the following parameters in our calculation. Future growth rate would be low, 3%. Future P/E would be low, 11. In this case, the fair value of the stock today would be $27. Second scenario. Truist will have average performance in next 5 years, and we will use the following parameters in our calculation. Future growth rate would be average, 5%. Future P/E would be average, 13. In this case, the fair value of the stock today would be $38. Third scenario. Truist will have high performance in next 5 years, and we will use the following parameters in our calculation. Future growth rate would be high, 7%. Future P/E would be high, 15. In this case, The fair value of the stock today would be $52. As you can see, today the stock is fairly valued, $52, if we expect the company's high performance in future. The fundamentals are good. And the stock looks fairly valued. Keep in mind that, the revenue will grow only by 5% on average per year in the next 5 years. The stock has been on my watch list for a while, and I'm tempted to buy it, but I think I will wait until it drops below $50. Company strengths. Truist Financial Corporation is an American bank holding company. The company was formed in December 2019, as the result of the merger of BB&T and SunTrust Banks. It operates 2,781 branches in 16 states, and offers consumer and commercial banking, securities brokerage, asset management, mortgage, and insurance products and services. The combined company has about $540 billion in assets and ranks as the sixth largest bank, for both assets and deposits in the U.S. Truist's now combined operations will allow the bank to reach new levels of operating efficiency and profitability, previously out of reach when BB&T and SunTrust were separate franchises. The company keeps growing its insurance operations at an above-market rate. Additional acquisitions, higher interest rates, and the falling out of acquisition-related expenses, means Truist will see uniquely strong core revenue growth, along with falling expenses. Truist benefits from a strong balance sheet including sound capitalization, healthy credit quality and robust levels of liquid assets. Truist's return on assets of 1.2% is in line with the rest of the industry. Truist has a yearly dividend yield of 3.66%. The dividend is nicely growing with an annual growth rate of 7%. Risks. Truist faces risks from general economic conditions, credit and financial market disruptions, interest rate movements, and changes in regulations. The company also has a growing insurance operation that subjects it to property casualty underwriting risks. In addition, it may be unable to achieve the expected merger cost savings in the expected time frame. If inflation begins to feed into the expense base, future expense levels may disappoint investors. Truist's return on equity of 9.6% is worse than the rest of the industry. The industry average return on equity is 12%. Its profit margin of 29% is below the industry average of 33%. Based on estimates for the next 5 years, the company will show a small growth in earnings per share. The EPS will grow by 8% on average per year. The revenue is expected to grow by only 5% on average over the next 5 years. Thank you for watching. If you found this video helpful, please hit the like button and subscribe to my channel.